Want a simple way to invest in the biggest winners from the AI boom? New ETF filings in the US aim to bundle AI leaders and mega-cap tech into single-ticker plays, but they also raise fresh questions about concentration and risk. Here's the setup. A handful of giants have driven most of the market's gains as AI spending lifts software, semiconductor, and cloud platforms. Asset managers are responding with ETFs that specifically target these leaders, moving beyond broad tech indexes. At the same time, interest rates, earnings momentum, and the staying power of AI-driven growth are all in flux, making portfolio construction more important than ever. The first insight is about focus versus diversification. These proposed funds lean into a concentrated approach, packaging a small group of companies that dominate AI infrastructure and adoption. That can magnify upside if leadership persists, but it can also increase volatility if sentiment turns. The second insight is rules and transparency. Prospectuses are expected to codify how stocks are chosen, market cap thresholds, relevance of AI revenue, or active manager discretion. Clear methods help investors compare funds and understand when holdings might change. The third insight is benchmark reality. By late 2024, a narrow set of tech and internet platforms made up roughly 30% of the S&P 500's value. With Microsoft over $3 trillion and Nvidia above $2 trillion, index moves often hinge on just a few balance sheets tied to data centers, chips, and software monetization. Funds that mirror this reality may track performance more closely, but also concentrate risk. The fourth insight is the regulatory path. Filings move through the SEC's review process, introducing timelines, disclosures, and potential adjustments before launch. Until approval, details can shift, and not every proposal makes it to market. So what should investors do now? Map your current exposure. If you already own broad market or tech index funds, there may be heavy overlap with these mega caps. Consider how a concentrated AI ETF would change your risk profile, tracking error, and sector weights. Watch for expense ratios, rebalancing frequency, liquidity, and tax efficiency. Stress test scenarios: strong AI demand, slower spending, or rate volatility. Decide whether you want a precise satellite holding for AI leaders or prefer diversified exposure to the broader ecosystem. The bottom line: targeted AI ETFs could offer clean access to market leaders, but they also bundle concentration risk. Match the tool to your objective and let allocation size do the risk control. Read the full article at finlitica.com.